Hello, I decided this year that I'd like to add some videos to the YouTube channel on personal investing, in particular investing in the stock market. As an asset class, we call the stock market, of course, publicly traded equities. And the reason is that I spend no small amount of my time constructing my own portfolio. I gave my own portfolio a name, Tech Turtle, because I contribute articles for Seeking Alpha, where I've generally disclosed the status of that portfolio and my trades over the last several years. But I've also been a writer over at investopedia.com. I wrote years ago many articles which are still on the website. But before I did any specific videos, I wanted to do this video first, where I transparently review my own Tech Turtle portfolio. So that's my individual retirement account. This is my own IRA. And the reason that I wanted to start with transparency is just born out of my own personal experience as a consumer of financial opinion material, content over the last decade plus. And that frustration is that so oftentimes I want to know exactly where the author stands and whether they have skin in the game, right? You'll read an article, compelling case to buy this stock, or an article saying, listen, this is the reason this thing has warts, stay away from it or sell it. And I'm wondering, okay, if you believe in this company so much, how much do you own? When did you buy? Or when did you buy and when did you sell if you don't believe in it? Do you have any skin in the game? I'm oftentimes surprised at how hard it is to know that, or in general, how when it's just not disclosed. Seekingalpha.com, where I write, has some great mandatory disclosures, and I even go further than the mandatory disclosures myself. So you generally are required to know if an author holds a position or has an intention to buy. Otherwise, though, I found it's hard to get that information. And if I were going to, I manage my own money, but if I were going to a financial advisor, a financial planner, I find it hard to imagine that people go and they don't want to know or get to know the financial advisor's own portfolio, personal portfolio, and their track record. It seems to me oftentimes people are okay going to a financial advisor and maybe knowing, in some cases, nothing about the financial advisor's own performance in terms of their own portfolio and their own track record. So I'd like to know when I'm listening to somebody else's opinion. And so for that reason, I wanted to anchor any future videos on the status of my own actual portfolio so that later, if it turns out I make good decisions, I can refer back. And also, as I make mistakes, which I've already done, that I'm accountable to myself and to any viewer for those mistakes. And so I would just say there are two quick caveats. I'll try to be quick. The first is that I'm a part-time investor. I'm not a full-time investor, right? I think that's very important, and I think that's underappreciated in many cases. Even on Seeking Alpha, there's a lot of smart individual investors doing it part-time. I've worked in finance for over a decade, and it's just my opinion that the industry attracts a lot of smart people. Some of them are super, super smart. And by definition, in the industry, a lot of them work full-time, which in finance is oftentimes very long hours. So I do think it's relevant that in terms of the question of who are we up against, I think when we're trading, it's important, or investing, it's important to know the playing field. Who are you up against? If you're buying, somebody else is selling, and vice versa. Who you're up against is, in general, smart people working full-time, especially in large cap companies. I think that's very material. It doesn't matter how smart I am if I'm part-time. There's a lot of people who know, especially these large cap names, better than I ever will. Does that imply that I think there's no advantage? No. You have to answer this for yourself. For me, there's just really one advantage, and that's the advantage of patience, which I actually do believe is an advantage and is even more of an advantage lately. For reasons of career, most professionals in finance, money managers, simply cannot afford the patience that they oftentimes would prefer. There's just too much pressure to turn in the performance. So for that and some other factors that I won't go into it, I think the market continues to be impatient, and therefore patience is a source of alpha. but it does require some discipline. So that was the first caveat. I'm part-time. Let's be mindful of that. The second is that I'm going to share my entire equities portfolio. That's my entire IRA. In December, I made a decision in the sell-off to double down, and I took that to almost 100% equities. But I didn't want you to think that that is an overall asset allocation of my wealth, right? In fact, I still have more of my wealth in cash than equities, and even more of my wealth in my own small business. So this IRA, my Tecternal portfolio, is the entirety of my publicly traded equities portfolio. It's my IRA, and it's almost 100% equities at the moment. However, in terms of asset allocation, I'm not nearly dialed up to that extent on equities. That would be very aggressive, especially in the context of the fact that my portfolio has a heavy technology bias and quite a few growth names in them, unprofitable growth names. So keep that in mind. Don't confuse that for asset allocation. Those two things ought to combine into a general point that, of course, none of this constitutes advice, if for no other reason than I don't know your specific situation, right? Anyone giving you specific advice, including what's suitable for your portfolio, would necessarily needs to know the particulars of your situation, starting with your demographics, your age, your family, commitments, life commitments coming up, spending that you need to do. All sorts of facts need to be collected to understand your specific situation, but also your psychographics, and importantly, your risk profile. We could be the same demographically, and I could still have I have a pretty aggressive bent in this portfolio. So risk itself, I teach risk. We have different definitions for this. There's not just one type of risk, too. There's risk capacity, risk tolerance, risk appetite. We got to talk a whole video on breaking down your risk orientation, but I know nothing about your risk, and therefore this video can't constitute advice for you in that respect at all. Given those caveats, then, what I'd like to do, if you would like to view this video, is that I'll go through the following items. First, I'll pull up my spreadsheet and show you my publicly traded equities portfolio that I call the Tecternal portfolio, the full portfolio, which currently has 33 stocks in it. And you'll see later as part of my challenges, it's too many. I have too many. I just drifted in terms of size and ideas. So I need to bring that down. It's too many to manage. But I'll show you the actual portfolio and my performance, which has been good, better than I've expected so far. I'll go over the 4 tools that I use. Then I'll just show you the allocation, the classic asset allocation. I'm over 50% technology, but I'll also show you how that's not how I view diversification, right? To me, diversification is when returns are not highly correlated, right? Diversification is when one stock goes down, you have something else going up. That's the diversification I care about, and so far so good on that count. Then I'll show you my themes, because I'm bottom up. I research the companies, I look at the filings, but I like to invest within themes that I think are durable for the long run, because it's so hard for a company to have an economic moat that we can project out for any kind of duration, that I do like to be in winning themes like data science is a theme that I'm invested in. And then as I wrap up, I'll show you the 3 best decisions so far that I've made for myself. That includes my recent decision to double down in December in the sell-off when I bought some of the companies from my watch list. I mean, so far it's been a good decision. We'll see if that holds up. But then I have even more key challenges and regrets. The first one being, the first challenge that I have is working on my sell discipline. I have found I'm much better at buying than I am at selling. So far, Selling is more art than science to me. And then I'll just show you how I look at my monitor list. So I have 33 names, and despite all that detail behind my research, right, I simplify to a dashboard, right, green, yellow, orange, basically green, yellow, red, where I have a set of stocks that are in the green that I'm holding and I'm not worried about, yellow where I'm evaluating, and then my orange is my red. And those are the stocks that are on the bubble for me that I'm evaluating whether or not they need to be sold, either because they've had unexpected gains. So I need to look at them from a valuation perspective, because valuation is always part of my decision, right? Some investors don't do that. I don't follow, for example, Motley Fool too carefully because I don't, at least the last time I looked, there's not a lot going into the valuation. So I absolutely need to know where the price stands relative to my analysis of a fair market or intrinsic value. So I will monitor, I'll put on evaluation a stock for monitoring if it's had an unexpected gain such that I'm now, any discount in the stock has now been realized. But I also monitor based on fundamental information. If information comes out that changes my thesis, right? If the facts change, then we need to reevaluate our position. So I currently have 5 or so stocks that are in the red or orange zone of monitoring. So those are the topics that I'll go over in this rather long video, which will anchor any future discussions I have or any future videos I share with respect especially to public equity investing. Thank you. Among the tools that I use, this Excel workbook that I built, I call it my stock tracker, although I think it's the closest thing to a trading journal or transaction journal. I think a lot of professionals would recommend that you use a trading journal. The idea is that you capture all your trades so that you can account for your performance and learn from your own feedback. And I like that idea a lot because for me, when I buy a stock, there's 2 parts to it. There's the money part that I'm putting in risk, but I also view that initial position especially as an exercise in learning. So 50% of it, investing from my perspective, it's learning as you go. And I really get motivated to learn when I make my first purchase or initial position in a stock. So the transaction ledger is the data source in this workbook. And it means I have to be disciplined because I haven't hooked up this part of it dynamically. But I have to enter, add a new row for any new buy or sell. You can see my most recent purchase here. And then I have the trade, whether it's a buy or sell, the date, the quantity, the price, and then some computed notional values that I use in other worksheets because I happen to use pivot tables in Excel because they're quick, easy to refresh, and they give me different views that I can use for different purposes. Namely, if I want to use a view of an exhibit for an article when I write for Seeking Alpha, in most cases, I don't include the actual value of my position in dollar terms. This is the first time I've ever shared that kind of information. And so here's an exhibit of my equities portfolio that I call the Tech Turtle, because it has such a technology bias. And this is organized alphabetically, right? Starting with Apple, and which by coincidence just happens to be my oldest holding. I purchased that 6 years ago. And then I have a performance metric here, very simple. This is just capital appreciation. It's the current price relative to my average cost basis, meaning it excludes dividends. But importantly, it doesn't include the time dimension, right? So this is much inflated as comparison to an annualized measure, or what we might call a CAGR, compound annual growth rate. Right, my annual growth rate is not nearly this. This is a tripling of the average cost, just under $58 to recent prices of Friday, $179. So I'm still quite happy with that holding. And you can see here then I have 33 stocks in my Tech Turtle portfolio. At the end of the video, when I talk about challenges, one will be that I believe very strongly that I currently have too many positions, but I'll explain a little bit later why I say that. And you can see that the value of this portfolio is 600,000. So this includes unrealized gains of over 100,000. And without adjusting for any time, currently on a price basis, excluding dividends, I'm sitting on a plus 41% gain, average holding here of just a little over a year. So all in all, I would say I'm very happy with the performance of it. Do I think it's skill? How much is skill versus luck? Well, I do teach statistics, and so I would have to say that we don't know. We don't know. I would like to think there's a lot of skill in this, but statistically, I couldn't make a very strong case. It turns out that you need quite a bit of track record to start having any confidence in your ability to say skill. So for right now, I'm going to have to say there's been some good luck. At the end, I will explain a couple of places where I think I made some good decisions, but I've only had 4 sales, so this has not been a high turnover portfolio. I do expect to be going into more turnover because I do want to reduce just the number of positions that I have. But you can see here, I've only really sold 4: Discovery, Kroger, Starbucks when I got spooked by LinkedIn and the China threat. That was a key part of my thesis. And then Ventas is a REIT that I didn't hold for very long. I also, their last quarter changed my fundamental view. I'm all about the fundamentals. And then just same sheet sorted in performance now. So not alphabetically, but rather just by this column here, just price change without respect to either dividends or the time dimension, which is important. And we can see here that Alteryx is my highest performing, plus 15%. Only held it for 1.5 years. I did not see that coming when I bought that stock. But you can see that most of, I have I've bolded here to green down to, let's see, first 5, 10, 15 stocks all at plus 15% or greater. And so most of these positions I'm obviously very happy about, and also I'm fundamentally happy about as well. As we get down to the bottom here in red, it looks like I have 1, 2, 3, 4, 5 stocks that are in the red on a price basis. That's Volkswagen, Hewlett-Packard, Applied Materials, CVS, which is now CVS Health, which has just consumed a disproportionate, this funny thing about the losers, a disproportionate amount of my time and also of my losses. So yeah, do I wish I didn't make that trade? Yeah, for the moment I do, but we'll see how the long-term story holds out. And then my worst performer is Cloudera, which was part of my data cluster. My data cluster also included my best performer, so I'll say a little bit more about that lately. But you can see I'm down 38%. On a current value of 24,000, so I think that's a loss of $15,000 that I'm sitting on with Cloudera. So yeah, I don't like that at all. That brings me no joy, as they say. I have also a plot. I thought I'd just try this plotting that price change against years held, although this is on a logarithmic scale, base 10, you can see. And the size of the bubble chart is the size of my position. The R squared on this, that's the coefficient of determination, which is the square of the correlation coefficient in a univariate regression like this. For those technical geeks out there like me, my R squared here is 34%. It's not terrible. I don't have high expectations on R squared. So I'm going to say with my data set here, there is a gentle relationship between the price change and the period that I've held. And right, you can see I have out here, that's my Apple, longest held, 6 years, over triple of the position. And then here is that my highest performer, Alteryx, which I've held far less. And then right down in here in blue, that's my Cloudera. That's my biggest loser, minus 38%, as I mentioned. And then finally, I'll just sort these positions by price in a simpler view, bar graph. You can see here, this is definitely got some skew to it. Alteryx, Apple, and then looks like my 5 losers over here. But most of the positions here in a sort of modest gain position. Among the 4 tools that I pay for, probably where I spend the most research time is Seeking Alpha at seekingalpha.com. If you invest, probably heard of Seeking Alpha because it's such a thriving community of both professional money investors, money managers, but also individual investors who either are planning for retirement or also in retirement. A lot of the individuals in there have really deep domain, sector knowledge and of different stocks. So especially in the large cap universe, there's more coverage than sometimes you can process. But when you want to get the bear and bull in detail for some of the big names, I think Seeking Alpha is the source. A subscription to their essentials, I believe, is $239 per year. I happen to be a contributor there where I write articles. I also just blog post quickly my portfolio because I've also believed that it's important for me to be transparent if anyone's paying attention to what I have to say. But when I have a big decision to make, I try to write an article, which is very time consuming because this is a sophisticated audience. So I think having to write down the idea in an article form is a fantastic test of your conviction and whether or not you feel like you know enough to be making the trade. So my second tool is Stockopedia. I would not expect you to have heard of it. For me, it's sort of replaced my Morningstar subscription. I had a Morningstar subscription for many years, but lately I've been unhappy with it. I canceled it. As a paid subscriber, I was frustrated. They still throw banner ads at their paid subscribers, which I think is unacceptable. And also, the portfolio tools are very clunky. They have a new website, but it's not very well done. And then also, maybe most importantly, I found myself paying less and less attention to the analysts who are assigned in their different sectors. Too many of the price targets were trailing or after the fact in my experience. So I basically switched over to Stockopedia. They are out of Oxford, England. I was actually on vacation last year walking around in Oxford, and we bumped into their office, and I didn't even know they were located there. That's how interesting that is. But they have developed a fantastic website and tool, in my opinion. They keep iterating it. It is not cheap. It is $425 per year, but it's my primary sort of convenient look at my portfolio. So it has my holdings, and they also have their own rank scores from 0 to 100, where they rank these stocks on quality, value, momentum, and growth. Certainly, I don't pay over attention to these various signals. In many cases, I hold stocks that would be contrary to some of these indicators. My best performers, Alteryx, for example, is such a high growth stock, only has a 3 on value. However, I do like to know where my different positions hold up on these different looks, including I do like to know momentum. I was late to the game in appreciating the importance of momentum from a short-term perspective in any case. Also, Stockopedia has fantastic screening tools. If you want to screen according to a strategy like the Peter Lynch strategy, I think has been performing very well for them. My third tool, you probably not have heard of also, is BamSec. So this is a portal that really is a shell on top of the SEC filings. So for as long as I've been involved in finance, I have been analyzing in some form or another SEC filings. It's sort of my suspicion that a lot of investors don't actually look at filings, but I can't really give you data to verify that. However, publicly traded companies, as I'm sure you know, they publish 10Ks, annual reports that give fantastic amount of information about the business. I can't imagine investing in a publicly traded company without having read the 10K. I've read all my 10Ks, and I've read a lot of other 10Ks for companies I haven't invested in. Also, the quarterly reports, of course, are updates. Also, I think one of my favorite documents that I suspect a lot of investors don't read at all is the proxy statement. Why do I say that? Well, for several reasons, but let me just tell you that the proxy statement has the, by rule, has the compensation philosophy. So that's how the executive team is paid, including the incentive plans. And as a former compensation consultant, I think the compensation plan, it says a lot about the values and performance measures of a company. So I also would never invest in a publicly traded company unless I've read the proxy. I read every proxy of my holdings when they come out because I want to know how the executives are getting paid. So that's because that's part of the agreement between the board as fiduciaries of the shareholder and what the board says is important to management. I have avoided many investments by reading the proxy careful, or sidestep some landmines, I would like to think. BamSec is excellent shell, so to speak, on top of the SEC filings. The SEC website is very clumsy to use, but the BamSec site, also not cheap. Let's see, I'm paying $348 for that, but it's just very well organized, and you can see it allows me to highlight and store my notes. So I didn't mention you also get the transcripts as part of the paid service with BamSec, and earnings called transcripts are another thing. I wouldn't stay invested with a stock unless I've read the earnings call transcript. Sometimes I don't get to it immediately, but the earnings call transcript is just a vital source of information, especially the Q&A. So I like to have that all in a place I can easily get back to my notes. And then I have StockRover. This is a fantastic tool. I pay, what do I pay for that? $75 per quarter or $300 per year. And so this is just a great tool for all the fundamental metrics. It dynamically links to my portfolio accounts. And I use this to sort of manage where I am in my decision space. I think a lot about how do I make decisions? What are my biases? How do I make better decisions? I think that's a lifelong journey for me personally. How do I make better decisions? But currently, this is where I keep my dashboard, so to speak, in terms of my decision state, which, although there's a lot that goes into my thinking in it, I summarize it very simply with a sort of blue, yellow, orange sort of dashboard look that I'm always playing with this, how to do this better, but I have coded for my stocks that I like, that I've bought and I'm holding with some conviction in green, and then I have yellow I'm also holding, but I have less conviction or something else specifically that I'm monitoring about that stock. And then I have the orange state. That's evaluation, which I have in two tranches, right? So these are the stocks that, if I'm close to selling, it's these stocks in the orange bucket here under evaluation, but I have them in two different tranches. One is because of gains. In most cases, it's unexpected gains, like my Alteryx or my Chegg, where I had a good company. It's still a good company. It's just for reasons that I didn't expect. It just increased in price somewhat abruptly, which has happened a lot since December. And then I'm not, from a valuation perspective, where I was when I bought. So I do think gains are a reason to evaluate. So I put them in that bucket. And then I have evaluations that I'm watching because I have specific concerns about the stock. And looks like I have about 5 in that. So that was my 4 primary tools, and the total cost on that is not cheap. I do pay $1,312 per year for those 4 tools, but hopefully I'm convincing in the sense that I use each of them Each of them are key inputs into how I construct my portfolio. So at the moment, I think it's good value. Then this is from Stockopedia and just an asset allocation view, because I just want to talk briefly about allocation. The name of my portfolio is Tech Turtle. It is not a diversified portfolio. I'd never pretend that. In fact, I would say if you want to be fully diversified, just buy an index fund. I wouldn't even say S&P 500 because that's actually large cap. But you could easily construct a well-diversified portfolio with index funds. And if diversification is the only goal, why not just get an index fund would be my view. I'm only looking for some diversification. Mostly, I'm looking to express my view and make my own decisions. So I am concentrated in my positions with some specific sort of diversification, which I'll show you next. But you can see here, just on a naive asset allocation framework, I'm over 50%. It's always been the case. And in fact, this may understate it because some of these stocks that fall into other classic wedges are actually, to me, more technology stocks. And I have an energy here that I've added for the sake of diversification. But personally, I don't find this classic industry sector framework very helpful in thinking about diversification. I do have 15 of the 33 do pay dividends, right? So I wanted to mention that because I'm so overweight technology that you might think I don't have any dividends. But you can see almost half of my positions, in fact, pay dividends. Many of those are the REITs and real estate positions. But I also think that when we talk about growth versus value, I actually think it's not a terrible way to characterize a value stock as a stock that pays dividend. If you have a dividend grower, more often than not, that's also what we call a classic value stock. So I do think growth and value is a good kind of diversification. I don't want to have all growth and no value. I like to have value and growth, or put another way, I like to have high growers, but I do like to have dividends in here. And so you can see my highest dividend is Enbridge. That's an energy stock. That's a sector I don't know much about. It's really, I made that decision almost entirely based on my Seeking Alpha research and covering Seeking Alpha authors. And it ends up currently being one of my best holdings. It's plus 29% on price, and you can see it has the highest yield. Okay, so I looked at asset allocation from a classic industry sector perspective, which I said to me is not very useful. At least when we think about diversification, right? Having taught this concept for so many years, I define diversification as low correlation of returns. After all, if I'm holding the portfolio, that's what diversification means to me, right? It means that if we take a day or a month or a year, diversification means that if the market goes down, I don't want all of my stocks going down, right? I define diversification as when things are bad, some of my stocks are still going up. On the flip side of that, that means that it's on most days, on most even good days, most stocks going up, but some stocks going down. That's my confirmation of diversification. So see, that's my point there. My point is that diversification isn't to me about location, doesn't mean you have stocks in different sectors or groups or industries. To me, true diversification is when your returns are imperfectly correlated. They have low correlations. So I do look at this. This is a correlation matrix, and it's trailing 3 months. There's a lot of key measurement issues that go in here. This happens to be daily trailing over 3 months, despite the fact that I'm not concerned about daily returns. So if I were to look at another view, I'd prefer to take the periodic returns out with longer horizons, but no matter. Under most of my views, I have decidedly imperfect correlation, and therefore I have some diversification in what is otherwise a relatively concentrated and opinionated portfolio. Right, so you don't see numbers here, but the reds are high values of correlation, and then the grays are low positive correlation, and then like the purples are actually negative correlation, so that's really good diversification. So it's a satisfactory outcome for me. And then in terms of themes, really quickly, I'm bottom up, but I like to choose my stocks within themes that I think are durable over the long run. Although the first theme here is just my anchor long-term value picks, right? The two stocks that I bought first and then second are Apple and Bank of America. I bought them as value stocks because I bought them when I felt like they were significantly discounted from their fair value. In both cases, that's currently the case anyway. I've already mentioned that Apple has more than tripled since I bought it 6 years ago. Bank of America is plus 75%. It's off a little bit lately, but it remains in my long-term value view. Then I have a data science cluster, which is more recent. So this is another tactic of mine, having been training myself in data science and being a big believer in this theme. When I went to look at the stocks, as I often do, I felt like I love the theme, but I do not have enough time, expertise, all of foresight to pick a winner. So in that situation, when I like the theme, but I don't know who the winner is, I like the idea of buy a cluster that you think might have a winner in it. And so it turns out that's basically what's happened here, right? When I knew I wanted to be in data science, then I gathered my list. I started with a long list. I narrowed it down. And then without going into the details of why, I thought, okay, Alteryx, Cloudera, and Hadoop. I said Hadoop, but I meant Hortonworks. I ended up buying that cluster of 3, thinking that I feel pretty good about the cluster without knowing which of the particular views and companies is winning. And so it is very interesting. As of today, Alteryx is so far my biggest winner. Cloudera is my biggest loser. But net, on a dollar basis, I'm in a strong positive position. In the meantime, Cloudera and Hortonworks have merged. So we're at a very interesting time for Cloudera. I think either I'm very right here or very wrong. And then I have technology value theme. Definitely won't go into detail all of these, but because there's so much that could be said about each one. But I own Facebook, Alphabet, formerly Google. I own Hewlett-Packard. That's not enterprises. That's the Hewlett-Packard that makes the consumer PCs and the printers, and is a pretty good bet if you like the 3D printing theme, which they've recently started to talk more about and recently started to share about some of the sales there. So that's an exciting 3D printing play. Applied Materials, my semiconductor, that I'm sitting on a loss there. And then Skyworks Semiconductor, I'm sitting on a gain, made that purchase, mostly informed by my research on Seeking Alpha. A lot of the smart money on Seeking Alpha felt good about Skyworks, and so far that's been a good decision, although that's a risky stock. So that's my technology value. Feel pretty good about it. Facebook is interesting for me because it's one of the 2 or 3 stocks that I hold that fails my governance test. I like to see what I call good governance. I won't go into detail on what governance is, but Facebook decidedly fails my good governance test. I'm sure you can probably guess at why. Yet I hold it because to me, the discount relative to its fair value is still significant. And so I feel like that's just sort of easy gains to make. But I will get out of Facebook when I realize my price target, because I don't want to be in a company where I don't like the governance. Then for technology growth, this is even more forward-looking technology companies, but I have Dropbox, YEXT, QTWO, highly speculative, Pivotal, a fantastic company, and Zora, a subscription company that for the subscription theme, which I happen to adore. So these include some very cool companies. Its technology growth is obviously risky. Then I have FinTech, where my anchor is Q2, and my Q2 holdings has done very well, plus 72%. I recently wrote a whole article about them where I feel like they're fairly valued, but we're still worth holding on. So at the moment, risky position, but they're in a good space. I more recently added BlackRock and Green Sky. Then I have a learning theme. This is the one that's closest to me personally, that I'm probably most comfortable with, being in the learning business, where I have my highest conviction holding is in structure. I've added to that 4 times as we go, and I'm very happy with it. I'm plus 10%, which is not nearly my best performer, but I've written several articles about them in detail, but it was my highest conviction because of the risk reward profile. I always felt like the risk was relatively low, given the fact it's a software as a service company, a SaaS. So not typically thought of as a low risk sector of technology, but this company with its high net retention rate, sticky business, fantastic reputation and educational, also gives me the option on their business product called Bridge. And so I still just love the risk reward profile. I'm happy to take my modest gains while holding on to this embedded option in a monster opportunity, a huge total addressable market, a huge TAM. And then I also have Chegg in there, which in the meantime has done much better. My Chegg performance, it looks like, is plus 76%. Also in the learning business, a fantastic turnaround story there. Okay, won't go into detail. Aside from technology, my other biggest theme is real estate, where I doubled down in the December sell-off, just feeling strongly that the research fundamentals, pent-up demand, were looking good. So I doubled down on Lennar, where I've added a couple times. Fantastic company, and also on a home builder that you probably have not heard of, based out of Newport Beach, called William Lyon, because the discount on the company was just too severe, I felt, to persist. And so some of that discount has already been eroded for some good gains, and we still have a solid company, a small, probably one of the smallest publicly traded home builders. So it's a risky position, but I still like them. I also have in there Redfin, and where I'm continue to learn more about Redfin versus Zillow and Redfin's prospects, although disappointed in their market share penetration. I have to say that my optimism has been a little bit waning lately, but we'll see. And then still related, or still part of the real estate, you can see I have Real Estate Investment Trust REITs. I actually have 5 positions in REITs. My oldest is Physician Realty Trust, very high quality. The ticker is DOC. And my source on here that I didn't mention is Brad Thomas, who I do pay for his newsletter, one of the experts on REIT. So only after I followed them for a while, read a lot about them, was I comfortable making my first REIT investment in Physicians Realty Trust. And then Invitation Homes and American Homes for Rent. These are single family rentals. I started with Invitation Homes, as a test position to learn about the space. And then as I become more comfortable, I added American Homes for rent because I liked the specific business that they're in. And I was having a hard time sorting out the relative pros and cons between these two. So this is a rare situation where I just bought the two competitors because I like the single family rental space. And I really went back and forth on the different pros and cons. They're not exactly the same, but they're both look promising. And then I have here two data center REITs. So you can see more technology even in my REIT. And obviously I've stayed away from, for example, the retail and mall REITs. In terms of the REITs, that subdivides, of course. And from my view, there's just a number of REIT subsectors that I stay away from. I just don't feel qualified. Sometimes they look so cheap, like Tangier, but I don't feel qualified enough. Then I have a familiarity bias theme, and these are just where stocks where I had to admit, no, mostly I like these stocks because I like the companies and the products, right? Sprouts is a market that I go to that I really adore, and I think they're so well done. I was in Kroger's, but I sold that. I don't like the grocery business at all, so I don't plan to stay in Sprouts for too long, but I just like the company too much. And then Zero is the accounting that we use for Bionic Turtle. So I suppose they compete with Intuits and QuickBooks, but they're based out of New Zealand, and we chose them as an accounting system after a review. It's a fantastic SaaS company, cloud-based accounting system. The growth is phenomenal. The customer loyalty is phenomenal. The community and ecosystem that they've built around it is phenomenal. So my stock has done well, and the growth story just continues. So I think this is a great holding. And then I added TJX. They have the Marshall Max. That's Marshall and TJ Maxx. So maybe reluctantly added a retailer, but after the last quarter, this is one retailer that really knows what they're doing, and I just feel like this is a great stock to be holding. Even now, after they gained after another great quarter, they just seem to know what they're doing. Deep value is CVS Health and Volkswagen. Both of these I had called special situations, just discounted, but I'm currently at a loss in a losing position. So I'm not sure that I've done a very good job on deep value, or maybe I need to be more patient. And I continue to be. There are some reasons to like each of these companies. And finally, Enbridge is my energy company. Again, don't know much about that sector, but that was mostly based on research that I did at Seeking Alpha, where so many of the smart money professionals that I follow felt good about this, and the performance since I've held has been nothing short of phenomenal, actually, and I'm getting the dividend yield. And so in terms of my monitor list, here's my positions. Green are the stocks that I'm owning and that I feel good about. Yellow, I'm holding, but I have less conviction around. And then orange are under evaluation for me. That means that they're candidates for sale, but for two different reasons, right? In the case of four of them, it's because I have unexpected gains on those positions, and so that's really just means from a valuation perspective, I want to revisit those. And then I have five that I'm watching due to new information that's come in fundamentally since I purchased the stock, right? So Hewlett-Packard, for example, not this last quarter, but the quarter before, they had a bad quarter with some unexpected issues in supplies in a business that heretofore they had been running very smoothly. Some very bad news, and the stock did react negatively to that. I did not panic at all. I waited for this quarter. This quarter has been much better. The stock has somewhat rebounded, and but I want to continue to watch Hewlett-Packard. It's just in a difficult, highly competitive space. So then I just wanted to wrap up with best decisions and maybe big challenges, right? So, and I could just want to focus this as much as possible in terms of my 3 best decisions or where I think I've done well. The first is my focus on fundamentals, right? I haven't so far sold a stock in panic. I've definitely had the temptation, right, in December, or even more recently, bad quarter, stock gets hit, and you sort of reach a little bit of panic. You think, well, if people are selling, maybe they know more than I do, and maybe I should get out too. But I have to say, I have not sold yet on panic, and I try not to use price as an input in my decision, right? For me, price is what? It's either the price I'm going to pay for something or it's the price I'm going to get on sale. In the meantime, I want to take advantage of it. So that fundamental focus allows me to purchase good value. Second thing in recent memory that I've done is I doubled down after the December 2018 sell-off, right? You're probably aware of that. And basically, you know, the chairman of the Fed said some things that the market didn't like. There was a pretty wide sell-off. So I have a watch list, and then several of those, I looked at those stocks, and several of those stocks on my watch list were more attractive from my valuation perspective. So I basically loaded up this IRA. I went to almost 100% in equities. I think I was maybe 70% before. So, and I increased my housing exposure as well. So in December, all through December, I added to positions as I felt like, no, fundamentally for these companies that I like, nothing's changed. I'm going to take advantage of these prices. I'm now, as of Memorial Day, I'm in a little bit different position because I've had some gains on those, some of those unexpected gains. So now I have a tougher decision as to which to sell and when to sell. I consider that to be a much tougher decision than to purchase. And the third thing I would say that I'm happy for myself about what I've done is I've just avoided battleground stocks. I think of Tesla, for example, and there's a lot of stocks where so many people and individual investors are talking about these stocks, following these stocks, making opinions on these stocks, that I just don't want. I don't want to get distracted by the noise, and it's just too challenging for me to participate. I'm not sure how to win. I feel like I could lose. So as a general rule, I try to avoid battleground stocks. And then my challenges are many, but the first one is the sell discipline, which I'm a long way from having one. So maybe that's a weakness, but as mentioned, I think that's very difficult to know when to sell. If you have gains, you feel like they're winners, you don't want to sell them too early. If you have losers like CVS, you feel like, well, maybe I haven't been patient enough. So very challenging. The other one is in part because of my double down in December, I have 33 stocks, and I've realized as a part-time investor, it's just too many to follow. It's significantly more stocks than I want to follow, so I do want to reduce the number of different positions that I have. Third, I've discovered that I'm out of my depth in regard to some of these companies, in particular semiconductors, right? Applied materials. I learn a little, and all that does is tell me how much I don't know and how difficult it is for me to predict how this company is going to do in the future. So I'm sort of deciding whether or not I should just be out of sectors like semiconductor where I feel like it would just take too much time to have the necessary amount of expertise. And then have regrets. Several companies that have sat on my watch list and I've just watched them go up. Chief among them, Microsoft, which under their new leadership has turned into what looks to be a fantastic long-term holding. It's always just been a little bit rich for my valuation discipline because I always look at valuation. And although I wish I would have bought it when it first showed up in my watch list. So that's one of my key challenges. And that about summarizes the state of my current position, Memorial Day 2019. If you've listened to the whole video, then I really do appreciate your time. Thank you.